In-depth analysis review of the 1970s stagflation. Hey everyone, this is my channel to help investors and traders develop a probability-based mindset to succeed. Also try and keep friends informed of what's going on in the markets and the economy, and also a little real estate content as well. This is Dan Mack, DXP Realty, aka the Trading Agent, and this is a in-depth analysis of the 1970s. I wanted to go over this because a lot of folks were asking me, you compare this to the 70s potentially with inflation and interest rates and housing prices rising and all sorts of things. And I just figured, if some people are going to ask, we shall deliver. If you have questions or anything that you want to pull from this video and follow up, please stop by the Discord room. Link is in the description below. Again, we are always here hanging out, teaching, trading, doing whatever needs to be done. Just do what the market is doing. That is always the goal, not be ego driven. Again, this channel is meant for traders who have experience but just seem to not be able to be consistent enough to put money in their pocket and make a full-time career out of this. I get it. It is hard. It took me a while to get there. On that note, let's just get into it. So first I have next to me, The Markets in Motions by Ned Davis Research. And if you don't remember the 70s because you weren't alive then, fair enough. It was basically what they called America held hostage to stagflation. You had Watergate, petrodollar issues, America loses its pride. That's basically how they described this time. You had, obviously, inflation. You had oil issues with the Arab oil embargoes. I mean, you had a lot of stuff going on. So keep in mind, in the 1970s, I think it was. What year exactly? The oil embargo began in 1973. So my guess is if you want to compare the times, I would think you start with somewhere like, I know you see this pop over here, but this is 1969. This is 1972, 2002. Here you go. I think we're in this point where you start this drop motion because, again, inflation is not going to go away. This is the problem when you don't invest in the inputs. Now, I know everyone says tech is the future, but people don't realize like the market cycles. I've talked about this year in, year out, day after day, and here's my video on it. Here's my Twitter as well. It's called Who Wins the Tech War? Long-term outlook. It's commodities. That's the irony. And so when you underinvest in tech, underinvest in commodities, oil, copper, steel, gold, silver, whatever you need to build, and you don't plan for it, there's going to be bottlenecks, there's going to be shortages, you become dependent on other countries. Now, again, I mean, no different than the Arab oil embargo, this war with Russia or whatever, this conflict is creating problems with the supply chains. And again, if you're newer to the channel, I talk about this all the time, the complete guide to volume price analysis. The economy will be subject to increasing dramatic breakdowns causing inflation, unemployment, high interest rates, and shortages of raw materials. We are in this phase. This is what causes a bear market. So anyone thinking we're not in a bear market, even though we are bouncing, think about it. Today is July 29th, July 30th. Market's been popping. Well, keep in mind, in a bear market, there are significant rallies. Like, that's part of the game. Like, I always tell people, bear markets really aren't necessarily like the end of the world. Like, the world market's going to go down forever. It just becomes a trader's market. And people really don't know how to deal with that because they get so conditioned to be diamond hands, hold on forever, always going higher. Like, that kind of stuff is absolutely dangerous to folks, and they don't realize it, but that's just the nature of the business. So let's get into what really you should expect. Personally, I think, going into next year, now this is again the timing. If you think about the seasonality of market's weakness in August, we talk about that in the summer into October. Think about it. Unemployment has not started to rise significantly yet, but we've seen the warnings, right? So it's not going to show up in the jobs number this week that's coming up. Because why? Those layoffs are coming in the future. Well, it's going to get cold again coming up. Is Russia going to press the screws to Europe? I mean, there's all these things that are going to create more issues, and the feds are tied. And so ultimately, either they have to raise rates, or we're going to have a fiscal default. Because people don't realize, like, if interest rates go to, 6%, and the government actually paid 6% bonds yields, I mean, it's literally like another defense budget having to pay an interest just on the debt alone. So there's long-term structural issues. What does that typically lead to? What? Market issues, right? Because again, ultimately inflation hurts the market because most companies can't do what? They can't pass that on without wages increases. And waging increasing takes plenty of time. It's not quick. So the market has to, what I would call, recalibrate to work its way back, ultimately to go higher in time, which I think it will, say in the next, I don't know, 5 to 7 years. Like, you should be at new highs, but it all really depends on what the Feds do. Do they go hyper print? Because then the market could go bonkers and go higher. So we have to be probability based. So the first thing that I keep telling people is, if you're looking for commodity, I think commodities will win the bull market, the next cycle by far. They will absolutely murder tech. Because remember, tech is deflationary. They love when prices of inputs go down because then they can sell more iPhones. They can sell more whatever, tech, just in general. Like, the inputs cost. Think about it as like bullets into a gun. Like, gun is tech is the output for gun. And the bullets are the materials, the raw materials. Well, we've not invested in raw materials. It's going to be an issue, right? Anyway, keep it really simple, because again, you can get really confused about this stuff. You can think about too many things. And if you just know it's a bear market, it's based on what? High input costs, high oil, again, creates eventually demand destruction, hence why it will go down in price. But when it bottoms, when we talk about the Fed pivoting, because again, a lot of people talk about the Fed is pivoted. No, they just raised 75 basis points. There's no pivot. That's not there. They're not there yet. So, because again, the jobs number aren't as bad as they need to be for them to pivot. And I think they'll continue to raise. But if you look at the bond market, this is what's interesting. The bonds yields have gone down. They're expecting deflation near term. Hence, I was saying, you have a window if you're looking to invest in real estate. You're trying to buy things with lower mortgage payments, whatever, payments in general, lower interest rates. This is the time to lock that in. Because again, I think inflation is here. It's going to anchor in just like the 70s. And that was the problem with the markets in the 70s during stagflation, is the companies themselves couldn't make a ton of money. But also keep in mind, though, the actual like percentages of materials to the S&P 500, the materials to the market as a whole, is super small. That's why I think if people, when the money starts rolling into the commodity names, you're going to see commodity names act like tech stocks. That's what you saw in the 2000s. That's when I first started really digging deep into trading. Because again, I started during the tech bubble. I witnessed all this crap. We have a tech bubble. And then what happened out of it? You had a 5-year commodity cycle that was insane. I mean, obviously that was built on China coming to power as a real industrial country. But what is this going to probably be like? All right, the 70s and 80s. And what did we know? Interest rates went higher constantly. Materials, inflation, all that, the prices continue to go higher. They did really well. And so here's the market as a whole was pretty crappy. And that's, I mean, again, I don't want to bash the administration, but I don't think they can know how to tie their own shoes. They don't even know what the hell is going on. Like, if we were smart, we would instantly, we would increase our output in these material names, oil, gas, whatever it needs to be, as soon as possible. We're not doing that. So, is what it is. Again, if you just review the charts, look, it's a sloppy, choppy couple of years. Now, again, everything seems to move faster with more information, right? So think of the 70s, whatever's going to get priced in probably gets priced in quicker. That's what I keep telling people. Like, you know, whatever happened in the past was slow based on what? People not really knowing much. Like, think of the 70s. How was information? Is in the news, is on the radio, on the TV, kind of. So now everything's instantaneous. So you have to speed these cycles. So compress this into maybe 3 years. That's my guess. Who knows how bad it's going to get. But I have to warn people, like, please, if you have cash, you need to invest it in gold, silver, real estate. Make sure it's getting inflation protection. Cash is not king, but cash has to be put to work. So that's where it gets really difficult with what to do with the market. So if you have questions, stop by the Discord room. But keep it simple. I think we're just going to be in this, you know, this is what's ironic, is at some point, I'm thinking, here's July, August. I think we're about to get some sort of dip, the next leg down soon. You might get this counter rally for, I don't know, it could be 6 months. I mean, it literally could be into next spring. It could be 9 months of just chop. I mean, again, a lot of it depends on what happens in the world. If the Russia stuff sticks around and it gets worse, well, then it's probably going to get worse. But be aware that war actually can be bullish the markets, because again, it's money spent to what? With a purpose. It's going to get used, you know. It's not like inventory builds up, like the tanks go out. I don't even want to imagine what war would look like these days, but that's what it is. So if you have questions, maybe this isn't very easy to understand based on looking on the charts, but I'm just trying to show you, like, that's what the S&P did. in the 70s during stagflation. If you do 900 down to 334, that's a big correction. I want people to be aware, like if you are thinking about long-term investing, this isn't the time to long-term invest. There will be opportunities to buy metals, materials, maybe uranium, copper, earlier in the cycle, because they will do great. Because again, they're undersupplied, they're going to need stuff, we're going to need that stuff. But certain parts of the overall market, remember, it's super tech heavy. That has to wash out. Like the tech money has to rotate, and then the market will bottom probably whenever that second bottom is. But the first bottom, the first VIX capitulation, talk about this all the time. The first spike in the VIX into the 50s, 60s, whatever it's going to be, is probably the time to buy gold, silver, uranium, metals, materials. Again, oil and gas, it's a little harder in the sense of the future because everyone's trying to get away from it. So I feel like investing in the materials for electricity seems like the smarter long-term play, even though oil and gas probably will have a nice run. Hope this helps. Trying to keep it simple. If you have questions, again, link is in the description below for the Discord room. Hit me up. I hope this helps, and I will see you guys and gals later. Thanks for watching. For more trading knowledge and insight, click on the videos on the right, and also join the Discord room. Link is in the description below. If you have any questions, please stop on by the Discord room and let's chat. Thank you.